Welcome to our presentation on national income. Today, we will explore the various aspects and significance of national income. National income measures the economic activities of a nation. It denotes the purchasing power of the country, and the growth of a nation is measured by the rate of national income. It is also an important instrument of economic planning. Simon Kuznets, a Nobel laureate, was the first to introduce the concept of national income, laying the foundation for modern economic analysis. According to Samuelson, national income is crucial for tackling major issues like unemployment, inflation, and economic growth. Alfred Marshall defined national income as the net aggregate of commodities and services produced annually by the labor and capital of a country, acting on its natural resources. National income is the total money value of all final goods and services produced in a country during a specific period, usually 1 year. Let's delve into the basic concepts of national income, including GDP, GNP, NDP, NNP, personal income, disposable income, per capita income, real income, and the GDP deflator. Gross domestic product, or GDP, is the total market value of all final goods and services produced within a country. It is calculated as GDP equals consumption plus investment plus government spending plus net exports. Gross national product, or GNP, measures the total value of final goods and services produced by the residents of a country, including income from abroad. Net domestic product, or NDP, represents the value of net output of the economy during the year. It is calculated as GDP minus depreciation. Net national product at market price refers to the value of the net output of the economy, calculated as GNP minus depreciation allowances. Net national product at factor cost is the total income payment made to factors of production. It is calculated as NNP at market prices minus indirect taxes plus subsidies. Personal income is the total income received by individuals from all sources before the payment of direct taxes. It is calculated as national income minus social security contributions and undistributed corporate profits, plus transfer payments. Disposable income, also known as disposable personal income, is the income available to individuals after the payment of income tax. It is calculated as personal income minus direct tax. Per capita income is the average income of a person in a country during a particular year. It is calculated as national income divided by the population. Real income represents the buying power of nominal income. It is calculated as national income at constant price divided by the price index during the current year and base year. The GDP deflator is an index that measures the price changes of goods and services included in GDP. It is calculated as nominal GDP divided by real GDP, multiplied by 100. There are three main methods of measuring national income: the product or value-added method, the income or factor-earning method, and the expenditure or outlay method. The product method measures the output of the economy by calculating the gross value of output from different sectors like agriculture, industry, trade, and commerce. When using the product method, it is important to avoid double counting, account for self-consumption, and exclude the sale and purchase of second-hand goods. The income method calculates national income by adding up all the income generated in the production of national product. This includes wages, rent, interest, profits, and more. In the income method, certain items should not be included, such as transfer payments and receipts from the sale of second-hand goods. However, rent for self-occupied houses and services provided by owners should be included. The expenditure or outlay method calculates the total expenditure incurred by society in a year. It includes personal consumption, domestic investment, government spending on consumption and capital goods, and net exports. The formula is GNP equals C plus I plus G plus X minus M. When using the expenditure method, certain precautions must be taken. These include excluding second-hand goods sales, purchases of shares and bonds, transfer payments, and expenditures on intermediate goods. National income analysis is crucial for understanding the contributions of various economic sectors, formulating policies, planning, and evaluating progress, and determining per capita income. It also helps in building economic models, making international and inter-regional comparisons, understanding income distribution, and arriving at macroeconomic variables like GDP ratio, fiscal deficit, and debt ratio. Measuring national income comes with challenges such as accounting for transfer payments, depreciation, unpaid services, illegal activities, self-consumption, capital gains, and statistical problems. National income and social accounting involve recording transactions among various sectors like firms, households, and government. This method is useful for economists and policymakers to forecast economic trends. Social accounting examines the relationship between national income and sectors, welfare, erosion of national wealth, US dollar terms, and social and environmental costs. A sector is a group of individuals and institutions with common economic transactions. Key sectors include firms, households, government, the rest of the world, and the capital sector. Firms undertake production, households consume and receive payments, the government handles public economic transactions, the rest of the world involves international transactions, and the capital sector focuses on savings and investments. A higher per capita income generally indicates better economic welfare and a higher standard of living, but it does not always guarantee welfare. Limitations to welfare include a higher proportion of capital goods, environmental hazards, production of war goods, and forced labor. These factors can reduce overall welfare despite higher GDP or PCI. The Physical Quality of Life Index, PQLI, is a better indicator of economic welfare, including standard of living, life expectancy, and literacy. Achieving higher GDP often depletes natural resources, reducing future growth potential. Therefore, the loss of natural resources should be subtracted from national income. Expressing Indian national income in US dollars can make it appear low. Using the Purchasing Power Parity, PPP, method provides a more accurate representation. Economic production generates both social and environmental costs. These must be considered when calculating national income.